Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and today, as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. It is that time of year as we get into October and November. One of the hallmark events on the Australian investing calendar comes around.
Yes.
And it's not the Melbourne Cup and it's not the footy grand final. We're not talking about that anymore. No, it is the Sohn Hearts and Minds Conference, where more than 10 of Australia and the world's best investors come to one city. This year it's in Adelaide, and they pitch their highest conviction idea for the next 12 months, all in the service of a great cause, raising money for medical research.
Yes, it's an amazing event. We were fortunate enough to go last year to the Opera House. As you said, it is in Adelaide this year. It's looking like a massive event, and today we have one of the experts who will be pitching down there in Adelaide. But if you're interested in going, you have two options. You can grab tickets for Adelaide itself. I think they're very limited. Or you can jump online and get tickets to the virtual conference. Now, we have a code just for Equity Mates to give you 20% off. So that's a $400 ticket. The link is in the show notes. You'll get access to all of those fund managers that Ren mentioned that they'll be pitching on the day.
And it's not just the fundies pitching stocks. There's also a lineup of speakers, thought leaders, headlined by Howard Marks, the co-chair of Oaktree Capital Management, one of the most famous investors in the world. So it's pretty epic that they've got him speaking. The whole event is on Friday, the 15th of November. So take a long weekend and head down to Adelaide, or take the day off work and watch it. Or, hey, just watch it at your desk and watch it on your company's time. But look, however you want to enjoy the day, it's an epic day. It's in support of a good cause, and we're really proud that we get to play our own small role in promoting it and supporting it. And part of that, Bryce, is showing the Equity Mates community some of the great investors that will be pitching stocks on the day. And today we've got an investor all the way from the US.
Yes, we're proud to have Sumit Gautam. He's the founder of Scalar Gauge. He founded it in 2017. He's the portfolio manager there and has been since it kicked off, but has extensive experience in private equity, which is where we kind of start this conversation with him today. So Ren, without further ado, let's jump into it.
Let's do it.
Well, Sumit, welcome to Equity Mates. Now, today we're going to dig into your investment philosophy, your views on the market, and of course, talk about the Hearts and Minds Conference. So to kick things off, Scalar Gauge was founded on a private equity style of investing with the benefits of public market liquidity. So can you please unpack that philosophy?
When people think of private equity, there are a couple of dimensions to that. The first and most obvious dimension would be that the investments that we're making, we're doing a lot of work on those companies. Sometimes it's hard to do that work in the public domain because the data is not always public, and in terms of the confidential data that the company has. So private equity has a lot more data to analyze than public investors, but we are able to dig into different market level dynamics. We're able to understand the point of views of customers. We're able to understand from the demand drivers and able to determine the profile of the company and the future growth rate and those prospects. So that's the first aspect when people think private equity, which is to be able to do a lot of deep diligence into the company. When we think about this, there's actually a second layer as well, which is that private equity is also able to influence their companies that they hold and able to create value through that control structure that they have. Sometimes it could be through board seats, sometimes could be more communication with the management teams. And so what we try to do also is that even though we don't have control, being in the public market, for most of our companies, we are able to have that discussion and dialogue with the management teams and dialogue with the boards. Sometimes we might take board seats as well in these companies and able to represent the voice of the shareholder to the boards and the management teams. That's creating value. So those would be the two aspects in which you create value. The last point, which I think is beneficial to us being in the public market, which is that when you invest in private equity, typically your capital is locked up for, say, 7 to 10 years. And the return of capital has become a very big issue in private equity, both in the VC side, but also in late stage private equity, the DPI aspect that people call it, and that's been very, very low. The benefit of in the public markets is that you have monthly liquidity and you can access your capital whenever you want to. There's usually a liquidity premium uh, that you would want to charge from private equity firms because of that capital lockup for 7 to 10 years. So what our proposition is that you are able to get many of the benefits of private equity in terms of returns, in terms of value add, while maintaining liquidity in the public markets.
There's a number of aspects of that philosophy that would like to unpack, but I think let's start on private equity because it has just had an unbelievable run over the past few decades really, but really the last sort of 5 to 10 years. It feels like the returns have been quite outsized, and I guess, as public market investors who don't quite have the check size to participate in private equity, we've certainly looked on enviously. But what is it about private equity that has led to such outsized returns? You mentioned a couple of factors there, but is that the extent of it, or is there more going on in that private equity style of investing?
I mean, at a very, very high level, the returns on private equity is driven by the capital structure that they have, which is essentially that if you lever up a good quality investment and you minimize losses, then typically your equity returns are going to be very, very high. And most people see that, most retail investors see that in the investment that they have, let's say in their primary house. So you buy a house, let's say $1 million, you put in 10% down payment, the remaining one you take debt, and debt is a very interesting aspect of boosting returns, as long as you make sure that you don't turn it into a zero, because the downside of leverage is that if the asset is bad, then your equity can go to zero. So the benefit of private equity has happened because of the interest rates that we had in the economy were very, very low. And so your interest coverage ratio is very low, and you can have much higher leverage on your equity investments, and higher leverage means higher return on your equity. So that's one. Of course, private equity have very smart people, which means that they're also making sure that the investments that they make are higher quality companies. And by investing in higher quality companies, you are avoiding the risk of it turning into a zero. And that usually turns into higher returns on the equity side. And finally, the impact of control and the impact of keeping the asset over a longer period of time. You get the benefit of time. So let's say, just as an example, let's say if you held an asset during COVID, then if you were a public asset, then you were marked to market on a daily basis. However, if you are not marking the asset on a daily or a monthly or even sometimes quarterly basis, then you have the benefit of sort of the time passage by which the management team can add value. So during the time of COVID, let's say if you owned a company in 2019 and you owned a company in 2021, and those were the 2 years that you saw, you might see that, things were great, right, from your output standpoint. But if you look at the company's value literally at that point in time in March of 2020, you might feel that, the asset is not creating value. And so private equity, because of this this aspect that they don't have to mark to market, they are able to withstand the some of these issues that public market investors might have to face on a periodic basis.
So, Sumit, one of your focuses is on rate of change. Are you able to explain the metric, define it for us, and then perhaps talk us through why you think it's important in identifying winning investments?
We have been so far talking private equity investment, and the public investing is very different than a private equity investing. Even though we might use similar tools, or we might offer similar return profile as a private equity firm, the the stocks, when they're traded on the public markets, they behave very differently, work very differently. Um, in a way that, let's say, maybe 10 to 20% of an investor in a public stock may come from fundamental investors. The rest are either passive money, or maybe quant funds buying it. There's a lot of other money flow that drives a stock going up or down, rather than just the fundamentals of the company. What that means is that we have to be aware of those flows. Um, in the public markets, rate of change has been a very important driver of returns from a stock standpoint. And what I mean by that is, let's say, if a company is showing financial profile of improving revenue growth rate, improving EBITDA margins quarter over quarter, year over year, it will generally be reflected very well in the stock price. The equity investors usually love seeing acceleration in either revenue growth rates or EBITDA growth rates, EBITDA flow through, onto the bottom line, free cash flow conversion. Those type of metrics are very, very important for the public market investors. And so when we say rate of change, we're essentially saying that we want to invest in high quality companies, but we also want to invest in high quality companies that are undergoing some sort of a positive change. It could be either a new management team coming in, it could be a new product, it could be an acceleration in their revenue profile or margins, net new growth rate. There are a lot of different drivers that can drive that rate of change in a company, but uh, those are rewarded very well in the public markets, and that's why we want to make sure that we capture both sides of it.
Let's turn to, I guess, your current view on the market, and maybe some of the philosophies will sort of shine through as we talk about your view on what's happening today. Because in preparation for this interview, we read some of the stuff on your website and some stuff that's been written by you and about you. And you do have some very fascinating views on AI and technology and software companies. But we want to start broadly, and we want to start with, I guess, a discussion about the divergence between the tech economy and the real asset economy. So can you explain what you're seeing and how that is affecting the overall economy, I guess?
Yeah, absolutely. So I'll mention a couple of thoughts. So I'll bucket them into a few categories. So let's talk about the first bucket, which is when people mention technology today, mostly they're mentioning the Mac 7 or the FANG type companies, so Google and Amazon and Facebook. Now, in our perspective, yes, those companies are technology companies, but not to the but we feel that those are mostly consumer companies and delivering over the internet. For example, Amazon is serving retail customers, and of course their delivery is different than a brick and mortar retailer, but it essentially is a consumer oriented company. When we think technology, we're thinking sort of more enterprise and business to business type companies, things that are going into the guts of your IT systems. It could be databases, could be middleware layer, could be applications that you're deploying to drive that, and those need a lot more understanding about the competitive landscape and the ecosystem of software. So that's a little bit of a separation in terms of thinking through that. When we look at the broader economy from our perspectives, right, from being a more technology and software investors, what we saw happen was that post COVID, there was a separation in what we call the real economy versus the tech economy. And the tech economy, because it could be delivered over internet, that it saw a big boost right after COVID, both in 2020 and 2021. The demand went through the roof. A lot of valuations expanded dramatically because the demand sort of was, I would say, pulled back from future years. Um, while at the same time, the real economy, your industrial companies, maybe a retailer, restaurant, anything that needed more real world interface, they lagged behind during that time frame. Um, and and we saw that reverse in the next 2 years, which was in 22 and 23, where as we saw a lot of technology companies went through a slowdown because of the pull in of the demand. They went through tougher comps in 22 and 23. The real economy actually came back up pretty nicely. And we saw that there's a lag in terms of the pricing power that many of these real economy companies have, and that pricing power showed up in their EBITDA performance. And so the real economy companies did really very, very, very well. I would say both in 22 and 23 timeframe, and only in 24 we're starting to see some sort of a separation happening in between these two categories. What we're seeing, which brings us to kind of the second sort of frame of reference that I will talk about, which is that that we're starting to see a little bit of a slowdown in the real economy, and a lot of that is coming from the pricing power that many of these companies had in 22 and 23. It's now reversing, and you're also seeing that in the inflation data. So as inflation is coming down, essentially you're saying the pricing power that these companies had is slowing down. And so as the pricing goes down, then the profit margin that many of these companies have, they are also slowing down. And so there is that reversal happening from a cyclical standpoint, as you can imagine, and that's happening over over a 2-year time frame. And that's causing a lot of disturbances in the economy as well. But I think looking at from that angle and that lens, it'll help you figure out what's happening.
Now, Sumit, you've also written that the AI capex narrative is reaching its high point, and it's unlikely to live up to expectations going into next year and beyond. So for all of us who are invested in the mega cap techs, and some of us who might be a little bit overweight, what are you actually trying to tell us here?
I think that there's a bigger topic that I want to discuss, which is what I call theme-based investing. And thematic investing is becoming very common because it's easy to perceive, and it could be as easy as, let's say, you believe that electric vehicles will capture a bigger portion of the overall cars in the next 5 to 10 years. So you want to invest in that theme. What we have seen is that in the past, and in most of my experience, that theme-based investing does not work in the midterm. It works in the very short term, and it might work in the long term, but it doesn't work in the midterm. Midterm is thinking in the kind of 1 to 3 year time frame. Before I go to the reason, actually, just as an example, so electric vehicles was one of the hottest thing that we all saw during 21 time frame, and many people started putting numbers to the battery companies, and including Tesla as well. In 2030, you say you only have to take 5% or 10% of the total EV market, and that would give you huge market sizes. And there's a flaw in that long-term thinking about these percentages, is because yes, over time EV is going to take share, but we don't know which company is going to be able to do that correctly. Or and we've been short a bunch of battery companies on that notion that their battery technologies just was not there, but they were just benefiting from this narrative or from this theme. So that's a bigger point for me to highlight to your audiences. In that same vein, when we think about AI, which I think is one of the most powerful themes that is capturing the imagination of people, that that you want to be careful with the theme-based investing, because the only way to invest today in that theme-based in the public markets is in the capex investment that's going on to enable the adoption of AI. And of course, we've seen that both in the numbers that from Nvidia and the stock price of not just Nvidia, but a bunch of other semiconductor companies, a lot of even utilities, data center companies. There are a lot of sort of thematic implementations that people have done in the public market, but also in the private market. So the VCs are all investing in AI driven themes, because that's what's capturing the imagination of people, but also the allocators. Our point of view is the following, which is that when we're investing in capex is by nature cyclical. That when companies invest a lot of money, then you can invest that maybe for a year or 2 year, and then you pause and you wait for the applications to rise on top of that infrastructure. We saw that, of course, happen in the year 2000 when we put in the fiber capex in the in the ground, and of course applications came on top of that. So of course, you saw the Google and Facebook had a bunch of these applications, and Amazon, but it was never exactly at the time that you think they will happen. And so this timing mismatch can happen even though the longer term thesis is correct. So that's an important thing for us to realize. The second important point to realize is that many times when these transformations happen in the earlier days, the government would actually be the entity would making a lot of this investment. We saw that happen with the internet, with DARPA, and we saw that with semiconductors as well. A lot of military and government spending drove a lot of this. The innovation in many of these fundamental technologies. What's happening this time is that it's actually the private companies that are making that capex investment. And so what it means is that they have a lot more scrutiny from investors to be able to show that return of investment at a much smaller time frame, which could be a few years, and it's definitely not over 5 to 10 years. And so to do that, that's why we have to have this now narrative. We're seeing a lot of companies and their CEOs are talking about AI, because you have to keep that narrative alive for them to continue making that investment, even though the ROI may happen this year, may happen next year, but driving that in from a public markets is the one that causes that tension in some ways. So our point of view is that of course all of this is great news. All of this is going to help us with productivity and in the longer term. But we just wanted to be cautious that we don't want to take any theme in sort of a parabolic move, which is what we're starting to see. I think when that happens, the chances of you not realizing the potential in that midterm is very, very high, which is what we anticipate might happen this time also.
Well, pausing on AI, there's been a narrative that's come out of, I think particularly the VC community, that AI will make pre-AI software obsolete, or software engineers obsolete, or just software as a category. It will be like massively disruptive to the software category. And you disagree, and you've written that you disagree, but we'll talk about some of your top holdings. You've also put your money where your mouth is in terms of your disagreement, and you think that there's plenty of potential still in the software space. So before we get to the individual holdings, maybe just talk to us about that narrative and the sort of the tension that's set up between AI and software, and perhaps where you disagree from a number of well-known VCs.
I would say that thematic investing, has its downsides, because sometimes whatever investors can think doesn't mean that's going to become reality. The bridge between a thought process and having it show up in real results is a big bar of execution. And I think most people will fall short on that execution. And I think that's the issue sometimes we're facing with AI narrative these days, is that if you can think it, that, oh, this is how it's going to happen, that software is going to be coded by AI, and so all software companies will get obsolete, or all the call centers will get obsolete because the responses to each of the questions that that customers have will be given by AI, but not by a person. I think that the gap between execution and that thought is, we think, is very, very high. What it means then is that the value of a software company in the enterprise side, which is where we invest in, is largely driven by their ability to drive results for their customers. The ability to code and create a product, yes, of course, is part of that value add, but a lot of it is, how do you interface with the rest of the organization? How do you talk to the rest of the software? How do you create a solution that can be tweaked or customized? Or how do I get my customer service if something is not working? And I think those are very tangible execution data points, which is what the value of a software company is baked on. When open source was coming out, in full steam, there were similar noise around that. Now that the software is available open source, then the value of any other company, can be, can go to zero. When Linux was coming in as the new operating system, you would say that, oh, Microsoft may not really have any value, because now you can just download, Linux for free and use that. Of course, we know how the truth came out, right? Which is that Microsoft is more valuable today, than at any point in time in the past. What it means is that the value of most of the software companies will have to be assessed based upon how sticky that software is. How easy is it for them to launch new modules that you can then integrate with your base software and able to charge a premium? How valuable do customers find your software, that let's say, if you offer something for free, they don't want to disrupt their existing organizations. And so there's a lot of other nuances that enterprises have, because they're running their entire companies on these software, and for them to just replace it with something else, it's a very tall order. And so we believe that there's definitely going to be disruption. There will be companies that are not good, and there are companies that can be easily switched, and those are not the companies that we want to invest in. I think we want to invest more in companies that are that have these characteristics of delighting their customers, having very high switching costs, being very well integrated with their customer workflows, and those type of aspects are the ones that we're investing in.
So sticking on the software theme, Sumit, according to your latest 13F, 4 of your top 5 holdings are software companies. You've got Zura, Enable, SolarWinds, and WalkMe. What are the metrics or data points that you're most looking at when considering investing in software companies? And I think also, in light of what you just said, delivering value to the end customer, and how are you measuring that?
The most important thing in our investing criteria is a high quality software company. And the way you measure quality of a company is its ability to make sure that the customers find the software very, very sticky. A perfect example I could give is your email or your Outlook. Like, every day you open your email, and you cannot live without your email, which is an example of a very sticky product. And so I think that we want to invest in companies which have very, very sticky product, which is sometimes measured by their gross retention rates. And typically, we're looking at companies that have gross retention rates maybe in the mid 90s. There are companies that we own which go all the way up to 98, 99%, which is very, very high gross retention. And we're dealing with companies that are selling their products into the enterprise side. They're very well integrated, very well absorbed in the ecosystem. They're integrated with SAP and ERP systems. They are also from a value add standpoint, they're delivering great ROI to their customers. We want to also invest in companies from the quality standpoint that have very high gross margin, which is one of the best things that software companies have. Is if you have 75 to 80% gross margins, then the incremental dollar of revenue that you generate flows to the bottom line. So the EBITDA can grow much faster than what the revenue grows. Then we want to look at net retention rate of these companies, which is, can you sell new modules? Can you improve pricing to the same set of customers? And then finally, we want to make sure that it flows to the bottom line. So which is are you able to get net incremental EBITDA per net new revenue? Are you increasing that over time? And it's very, very high. So there's a lot of criteria. Again, we've been doing this for 20 plus years. And so we have a list of those criteria and those companies as we evaluate them. Of course, we talk to a lot of customers. We talk to a lot of partners to get their feedback on these products. We have to be aware of competitive landscape and seeing that they are able to keep up on the innovation curve. So all of those aspects are there. So in that criteria list, as you mentioned, a few companies that we own. Actually, the fourth company that you mentioned, WalkMe, has recently been acquired by SAP. So that was a great outcome for us. The largest company that we own today is a company called Zuora, which has most of those parameters as we talked about, right? It's got very, very high gross retention. It's part of the billings. So the company does subscription billing software. And it's a very important part of a company's operation. It's very well integrated, in the rest of the organization. Customers love the product. They're able to add new modules. So they've added things like CPQ and RevRec, and they're now adding payments. So there's a lot more growth opportunity that the company has. And valuation is probably our very, very important criteria for us. So the company's trading at about 9 to 10 times forward EBITDA. The revenues are growing 8 to 10%. EBITDA is growing 15, 20%. So we like the valuation. We like how sticky is it, and we're also working with the management team there to make sure we can create value in that company. So that's kind of one example of a type of company that we like.
Nice.
Love it, Sumit. Well, I love speaking to experts, and when you see their portfolio and it's just a number of companies that I hadn't heard of before. It's just like a real reminder that there's so much out there. There's so many companies out there doing amazing things, and like our opportunity set as investors is larger than we could ever really truly get our head around. So some interesting companies for us to go away and take a look at. But look, you're coming to Australia. You're coming down to Adelaide, and you're going to pitch one stock at the Hearts and Minds conference. Now, as much as we'd love to ask you what it is, we're not going to. We're going to save that for the conference itself. But why is coming down to Adelaide, coming down to Australia, and participating in the Hearts and Minds conference important to you?
I have had very fond memories of Australia. I was growing up in India. Having the two best teams in the world in the sport of cricket. So that's been very close to my heart since my childhood. The cause that the Sohn Conference is supporting is also very close to me as well. Of course, we are doing a lot of technology investing, but I also believe that medical and healthcare is a big part of what the society needs, in terms of being able to do innovation. And I think that even though I'm not able to do that on my daily basis, I wanted to support an organization that is complementing that important need in society. So it's been a pleasure getting to know the organization, and we're big supporters of it.
Now, Sumit, we don't envy you or the other experts that are put on stage and asked to pitch an idea that's going to win over the next 12 months. Very, very hard to get up there and do that. But how do you go about that process of coming up with an idea that is for most of us as long-term investors just such a short time horizon? How do you?
A great question. I would say that if you minimize the parameters, it makes it easier. So I keep going back to the most important thing is that you want to invest in high quality companies. High quality companies generally compound capital over time, and maybe the return next year is only 10%. It could be 50%, whatever the number is. You generally have safety in understanding that your company is adding value over time, and that's the nature of a high quality company. So that makes it easier, and you ignore the time frame. The way we sometimes incorporate time frame is that rate of change process, right? We're trying to figure out whether the company is undergoing any sort of maybe not even transformation, but something that the next 12 months is better than the last 12 months. Either in terms of the growth rate or in terms of EBITDA flow through. Maybe there's something new, something exciting going on that could drive value more so in the next 12 months, per the time frame of the conference. But I think that I don't think that we make it complicated, or we don't think in terms of short term, long term. We just want to say we want to invest in good quality companies that compound capital over time, and the rate of change process helps a little bit more on the near term.
Love it. Well, if that has got you intrigued about what Sumit will be pitching, you can go to Adelaide and you can pick up a conference ticket, or you can pick up a virtual ticket. The link is in our show notes, sownheartsandminds.com.au/virtual. The discount code is EquityMates2024 if you want 20% off. But Sumit, we want to say a massive thank you for joining us today on Equity Mates, and a massive good luck as you head down to Adelaide and pitch on the 15th of November.
Thank you so much. Really enjoyed the discussion.
Equity Mates. I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.